Tiffany and Company released earnings just moments ago. The number came in at $1.12 a share. That was above the consensus estimate of $1.04. Revenue, though, was below forecast, and comp store sales dropped by 4%. However, Tiffany did maintain its full-year sales and earnings outlook, and the stock is up. Joining us with some instant reaction is Brian Nagel. He's an analyst at Oppenheimer. And, Brian, looking through this report, what would you say?
I think it's mixed. Just like you said, Becky, the stock is up here pre-market. I'll see if it holds. I think it's better than feared. But as I dig through this report, to me, it highlights a real problem for Tiffany, and that is weaker sales to foreign tourists, and particularly Chinese tourists shopping in the United States and elsewhere.
Because there are fewer tourists, Chinese tourists in the United States.
That's exactly right. And I tell my clients all the time, the Tiffany model has been built to cater to that traveling tourist, with a big store in New York, stores in Paris, elsewhere.
We basically knew that, though. I mean, Ralph Lauren told us that. Macy's told us that. We knew that was coming. So you see the weakness here. The gross margin is light as well. When we look overseas, is there any confidence that you could have that a lot of the weakness that you're seeing here in the U.S. will be able to be offset? I know they did the deal with, I think it's Reliance Brands, gets them into India. Are you going to be able to offset it?
To some extent. So Tiffany's made a big push, and to their credit, they've made a big push now to build a bigger presence in mainland China. Just like all the other brands you mentioned. Tiffany, I think, is further behind the curve. So that will help to offset somewhat. That helps to capture that the Chinese consumer is shopping locally as opposed to traveling. But it's going to take a while for Tiffany. Tiffany's been very focused on New York, Hong Kong, Paris, other traveling type markets.
Inventories were higher too, as well, right?
Yeah, and there's a lot that they were. I don't know if that's necessarily problematic. Tiffany's will be launching a number of new products. They've been building inventory in anticipation of that. So that's actually probably a positive. Yeah.
We did talk about the strong sales in China. They talked about double-digit growth in mainland China. So maybe the tourists aren't traveling here, but they are selling some in mainland China anyway. Can that make up for what you talked about with the weakness in their model?
A little bit. It's somewhat of an offset. I think when I look at that, I think that, the bigger positive, as I interpret, is it's not totally offsetting weaker sales to foreign tourists, such as in New York, but it still suggests that the Tiffany brand is resonating well in China. It's resonating well with that Chinese consumer.
So any concern about nationalistic tendencies, maybe not liking the U.S. because of the trade war, you see a Costco, you see a Tiffany, and maybe that alleviates some of those concerns.
That's exactly right. That's how I read it.
The CEO said sales came in below, net earnings exceeded, but when it comes to the second half, they do have some tough comps that are going up in the first half behind them, so it'll be easier in the second half. But they are concerned about some of the business disruptions they've seen in Hong Kong and other places, too.
Look, and I read it quickly. If you look at the components of the guidance for the second half, they did temper it a bit. I think Tiffany maybe made a mistake here by not getting more cautious on the second half of the year.
Right now, that stock is up by 2.8%. It was up by better than 5% earlier, but we'll see how it trades through the morning. Brian, it's good to see you.
Nice seeing you, too. Thank you.